Yo, what's going on, guys? It's Jason here. Before we start, please like, comment, and subscribe. It would really help out the channel a lot. Thanks. Also, thank you guys. Thank you guys so much for 22 subscribers. 22! That's like a lot of people. Thank you very much. We have like more than 20 likes now on this channel with the first two videos. I really appreciate you guys. Please keep it up. I really appreciate the support. Thanks. So I actually got a request from one of you guys. You guys want to know what's a good investment, how to tell if it's a good investment, and that's what we'll be talking about today. So feel free to tune in and watch through the whole video. So this video is mainly for the people who don't want to take too much time and look into their investments daily or weekly or sometimes even monthly. These are the people that want to invest for the very, very long term. So for you guys who actually want to like swing trade or day trade or trade by monthly basis, I would recommend you guys to just still watch this, see what you could get out of it. But I will be making more videos on those later on. So for you guys who are looking for more of a hands-off approach, I would recommend you guys to look into dividend stocks, bonds, mutual funds, index funds. Mostly index funds because it's a more of a hands-off approach. You don't have to spend too much time researching it, which I do recommend you to research before you do anything for a financial decision. So please make sure that you absolutely know what you're investing into, because that's your money and you obviously want to protect your money and make your money continuously working. You don't want to lose the initial investment that you have put in there. So the only difference between mutual funds and index funds is that index funds are broad and they're not actively managed. So mutual funds are actively managed by a professional, and index funds is a broad basket of a whole bunch of stocks, the whole top 500 companies in the United States that perform really well, and those companies are what considered the S&P 500. So that is more of a broad way to invest. Typically you could get 8% on that a year. Now mutual funds are controlled by professionals, like I mentioned earlier. So the professionals, they'll make active trades, they'll constantly look into new things, meaning it's not fully diversified. It could be concentrated in certain sectors. The sectors, just for an example, it would be like pure pharmaceutical products. Another sector would be tech, like Apple, Google. Now that you have the difference between those two, let's get into risk versus reward. The more risk, obviously, is the higher reward. Now the S&P 500 typically goes 8%, which means it's pretty neutral in risk versus reward. But mutual funds are a higher risk, but obviously it's a higher reward. So you want to have a mutual fund that has a higher track record or a better track record than the S&P 500, and make sure that the track record has been for the last 5 years at minimum, because you obviously want to have the least chance of losing your money. I would also like to add that the further you move away from 8%, the riskier it gets. So if you see a mutual fund or any sort of ETF or anything offering a 20% return, you should probably not invest in that, because it's very risky and you don't know how long they've been obviously in business. So you want to make sure that it's roughly from 8 to like 16%. Like 16 is pushing it, I'm not even gonna lie. 16% is really high for a mutual fund or an ETF index fund, because you have to watch your money and make sure that your money is in safe hands, because I don't want you guys to lose your money. So you guys have to use some really great due diligence if you're trying to push for extra return, and keep that in mind, that the higher risk, the higher reward, but also the more you move from 8%, the riskier it gets. So now that you guys have that, I really recommend you guys to start young. Well, if you are young, start now. You guys have a lot of life, a lot of years to have that money compound for you. Compounding is just when your money starts working for you, and little by little it just starts multiplying. Obviously it depends how much you put in there, and I do recommend you guys to put in money every single month, at least $100, and that would really help you guys out. Within 40 years you would be guaranteed millionaires, like I mentioned in my past videos. Also, I wanted to add this in. You guys, if you're young, you could afford to make mistakes. It's not like you're 60 years old and you can't do anything risky, or else you're gonna lose your life savings. You guys are young, you guys are healthy at the most part that I know of. be secure with your money, and you could afford to lose it. You gotta have to make sure that you could afford to lose it. If you cannot afford to lose that money, don't invest it, because it sucks when you have to borrow money, when you don't have money to be able to continue moving forward in life and whatever you needed that money for. So please don't invest money that you don't have. Now you guys have to be able to understand that your emotions are what controls basically anything that you do. If you could control your emotions, you're gonna make great decisions. So in choosing something good like stocks, dividends, you guys really need to have really great emotions. With index funds, you have to have really great emotions as well, because if you see the S&P 500 dipping down like 0.5%, and you guys get all emotional, all crazy, you guys are more than likely gonna make a really stupid decision and completely regret it later on, because the S&P 500 over a 50-year period continuously goes up. So please don't be emotional. So I know you guys have probably heard the classic buy low, sell high. So that phrase does hold some truth to it. You have to buy anything at a discount if you're looking to invest into it. Make sure that it's obviously at a really good price, a price that you feel comfortable buying it at. So an example would be, let's say Apple, right? If Apple is at $100 and it drops down to $50 and you purchase it, and 6 months later it's back at $100, you just made a 50% return. So the truth about buying at a discount, buying low and selling high, is that you have to protect yourself in case anything happens with the price, or if it doesn't even go back up to its average price, then you're still protected because it went up to 70. You just made a 30% return. I'm not good with math. So that's the good thing, and that's the truth about buying low, selling high. It's pretty simple. I really don't like the term because it's kind of old school, like, so it's everyone says it, but I like saying buying at a discount. I just went over all of that right now for you guys. I hope you guys understand that part. Here comes the juicy part. So if you guys are really good at something, like let's say you understand tech, you have an unfair advantage at that. Now if you have an unfair advantage at it, you guys should probably look into that sector list, like tech. You guys should look into it, do your due diligence, and probably look into what stocks you should invest into, because now you understand how it is. You also have to understand market cycle. If you buy at a really bad market cycle, let's say you buy at the top, you're obviously going to lose money. So be sure that you look into great companies, great sectors, and make sure you're in a good cycle, and make sure that you understand what you're investing into. Now, historically, September is not such a really great month for stocks in general. So you know what that means for you guys? What you guys have learned: if you buy low, sell high. I'm not telling you guys what to do, but you guys should probably look into some stocks and some stuff that's on discount. So probably look into that. I'm not giving you any financial advice. Just look into it. That's all I'm saying. Real quick advice: know what you buy and know why you buy it. That's a quote from I don't know who. I'm not even gonna lie to you guys, but just keep that in mind, and hopefully that helps you guys out. But other than that, thank you guys for watching the video, and thank you for getting to the end of this video. I really appreciate you guys so much. For 22 subscribers, thank you guys. Like, comment, and subscribe, and don't forget, I love you guys. Bye.